There are a couple of challenges. First of all, and this is a debate which we have currently in the press, in the academia, in the environment. And I'm talking much more about pragmatic economics here rather than what you learned, what you heard over today, over the entire day, which was much more about theoretical background and theoretical elements. So first of all, is inflation going to break the camel's, i.e. growth, back? To give you our answer right away, the answer is no. Nevertheless, we are going to have to talk a little bit about inflation. And that implies rising interest rates in our understanding. And hence, what should you as investor do in this kind of environment? Again, this is an environment which goes for the next, let's call it 6 to 9 months. But there is a much longer, much more important challenge which we're going to face, which is about basically the famous 3 letters, E, S, and G, or the green dynamics which have been evoked earlier on. So in essence and in a nutshell, we, for the next couple of quarters, we still remain a little bit more proactive as far as risky assets are concerned. And I'm going to pull all of that into a context of what we learned, what we heard over today, in particular about pricing. So first of all, cyclical perspectives, and I don't want to spend too much time about that. For those who are interested, the presentation is available. I'm pretty sure that the Institute is happy to share or contact myself or my colleague. The current recovery, in a nutshell, is very simple, very similar to the amplitude which we saw basically back in 2008, 2009. It's all expressed here in standard deviations. It's 2.5 standard deviations from negative to positive. So here, it's a very similar amplitude. Nevertheless, the speed of this recovery was much shorter. You see the 2 years back then, 1 year today. And that has ramifications on today's discussion, inflation, supply disruption, and so on. Nevertheless, after this kind of speedy ride back to growth, we're going to hit the road bumps, and this growth is going to come down. Nevertheless, growth will prevail in 2022. So that takes us to the question about inflation. What you see on the chart is very simple. The blue line is the personal consumer consumption expenditure price index as the famous measure or the preferred measure of the US National Central Bank, the Fed. There has been a huge gap built up over the last couple of years, which is now about to close. And the orange line is the year-over-year rate of change, and we're basically flirting with a 5% inflation rate as of today. So, in that respect, and as such, this wouldn't be a big deal. Nevertheless, the problem is here, we're going to have ripple effects into the economy, what the economists call about the secondary effects. And I think it's time that indeed the Fed, and yesterday evening we had the Fed, and we heard the Fed saying we're going to change. As I put it down here on this bottom line, Mr. Powell is his Zeit. Sorry, this is adapted to Rainer Maria Rilke. So we have growing rounds of second round effects. What I mean by saying that is the following. What you can see on this chart is very simple. The orange line is the NFIB survey, basically asking the percentage of firms that expect rate or compensations to increase. And the blue line, which has been flashed out via this blue flash, is the wage and salary increases, and we are going to head towards wage growth in the vicinity of 4%. That is problematic, in particular, if you look at productivity growth. Productivity growth in the US, I'm speaking of the control of my colleague over here, is presumably around 2%, by and large. Labor growth or wage growth of 5% versus a productivity growth of 2% is going to be a tricky thing. And that indeed means, in our understanding, we see second round effects of inflation coming through. That's not the case, not at all the case here in Europe. I would love to have higher wages, but that's a dream, even if basically trade unions claim for higher salaries and wages. This is not going to happen. So in essence, what I'm saying here is, indeed, in the short term, the industry is facing challenges, in particular via a prolonged inflationary environment, to which the Fed, the US central bank, is going to adjust its policy, presumably in 2023. But in the meantime, the long end of the yield curve, although the yield will rise, that's the blue line, and we expect basically interest rates in the US, 10-year US treasuries, to move towards 2%, maybe even higher than that. Now that was about inflation. And over the last couple of quarters, we had a lot of discussion about stagflation. Stagflation in a very short term is basically massive interest rate hikes that brings down growth due to inflation. Interest rate hikes due to inflation that brings down growth. We had that kind of situation back in the 70s, ladies and gentlemen. We had a similar situation in the period of 2004, 5, 6. And today we are again in a very similar situation. Apologies for this German right here. On heute means basically today. Look at the real interest rates. Now I need to tackle this issue via the pointer, if that works. Back then we had short-term interest rates, Fed funds rates, at peak rates at 20%. 19, I think, was the peak rate. And consumer prices around 12-ish. 2004, 5, 6, we had interest rates, real interest rates close to zero. Today we have real interest rates, short-term interest rates, deeply negative. So in essence, what I'm saying is that indeed, today's situation is certainly not a stagflation discussion, and it would be complete obsolete to discuss stagflation like in the 70s. We are maybe closer to the 2004-2007 period, but nevertheless, it's an inflationary environment. So no discussion about stagflation. That all of us basically means that over the next couple of quarters, we're going to remain more or less invested in risky assets. There is nevertheless a big change looming on the horizon. And the big change is nothing else than the US Fed changing its tag. And again, yesterday evening, I think we learned, and we got confirmation that the US Fed is going to start tapering. Tapering in their terminology is nothing else than basically slowly closing the robinet, closing the tap, by 15 million per month from 120 million purchases per month so far. That takes us into middle of next year. What I'm saying here is that the blue line, excess liquidity, so additional liquidity which kept the markets floating, has done its course, it's run its course. This booster has burnt out. And now to take risky assets higher, we basically need the green line, which is earnings growth, and they're coming to fruition, ladies and gentlemen. So in this kind of environment, we are still proactively tilted towards risky assets, but we also know that this kind of period is not as buoyant for risky assets as the liquidity booster. That, ladies and gentlemen, would then take me to the much bigger challenge that our industry is facing. And here I have a quote from the PricewaterhouseCoopers Growth Opportunity publication, which is exactly and stipulates exactly what we are feeling and what we are facing each and every day. ESG, environmental, social, and governance themes represent basically the largest, in our understanding, fundamental change in the investment landscape since presumably the introduction of ETFs. And this is going to be a big change. The numbers here are in the vicinity of 5.5 to 7.5 trillion euros by 2025. And that is basically roughly 50% of European assets. So there's a sea change coming up. AXA as a group, we have committed to purchasing something like green investments to the vicinity of 25 billion by 2025. And we have ambitious objectives, investment objectives, and they are well-defined targets. So in that respect, we are on the forefront of things, of getting greener investments. Our understanding of the different vectors of investment and responsible investment are defined about negative screening, ESG integration, all the way to impact investing, which becomes a much more powerful tool today, where we as an investor basically have a constructive dialogue with corporates to make them change their minds. And I'm pretty sure you all, ladies and gentlemen, will see a lot of companies basically splitting into two, separating the energy part from other productive elements. That is a trend which has started and which will continue. I'm not saying that we are at the heart of this kind of change, not at all, but we accompany this kind of changes and we interact, we liaise with the corporates. And in doing so, I think it's worthwhile to share with you a couple of numbers. Basically, as one of the main investor here in Europe, we have basically intervened and participated in more than 6,000 general assemblies. And in more than 50% we voted against management. So we take part as an active investor. We have more than 300 direct engagements with corporates. There are some company names up there with which we have a continuous dialogue, ladies and gentlemen. And more than 80% are part, thank you, timekeeper says 5 minutes to go. I think I simply have 2 or 3 slides to go. With more than 80%, we are basically directly related to the United Nations Stability Criteria, the UN SDG, concerning climate change, ladies and gentlemen. And with this chart, I simply want to share with you, indeed, green has become a major theme. It has become mainstream today. And now there comes the downfall to that, the headwind. Basically, we have very little regulation, or maybe even too much regulation. And what I mean by saying that is, we are in a situation where the regulatory changes are basically occur on a daily basis. So there is little clear guidance in that respect. There is today the SFDR regulatory environment, which is in place, but it's been an evolution since we started that project back in before the year 2000. And today, basically 90% of our assets are in Article 8 or 9, so we comply with the regulatory environment. Nevertheless, we as investors would like to have a clearer framework what the regulatory environment is going to be and going to look like going forward. Here we are basically shooting at a moving target. AXA IM, the investment house for which I'm standing here in front of you, is basically on the forefront. We have, what you see on the chart is nothing else as our rating. Basically, that's the essence of where we can be. We have a AA or a A+ rating, which is the highest rating overall compared to the industry standard. And now, the final chart with which I would like to conclude, ladies and gentlemen, is the following. ESG is mainstream today, and it's going to be even more important tomorrow. What you have on this chart is nothing else, a very humble comparison between return, total return indices. In green, obviously, the MSCI ESG leaders, and in orange, the MSCI All Countries World Index. That's the price tag with which I would like to conclude my little presentation here, is that indeed, this move towards green is beneficial for investors. The so-called outperformance of 70 basis points per annum is by no means negligible in our terminology, in our understanding. And that simply means, ladies and gentlemen, that over the long run, let's call it the next decade or so, the orange line will most likely disappear. And what I mean by saying that is that pricing and free market mechanism will force corporates to become green, to morph towards green, and ESG is going to be a basically self-explanatory label, meaning that there is no necessity to distinguish between classical investments and ESG. At the end of the day, the market prices and the market forces will basically force corporates to move towards ESG, and I think this is our humble contribution to the green movement you alluded to earlier on. Thank you very much for your attention, ladies and gentlemen.
Thank you very much, and the floor is open for questions. Does anyone have a question? Okay, there's one man, or two men in the back. Oh, probably better with the microphone.
Yeah, it's easy for me to understand. Sorry.
Thank you for your talk, first of all. I was wondering, in commodities, it's often the case that when basically there's an underinvestment in capex for a very long time, that comes back to bite the markets in terms of higher commodity prices, and eventually those prices become so high that the market does invest into those companies again. And I was thinking, for example, in the oil markets, that those companies aren't getting a whole lot of capital right now, and with this ESG stuff, they're going to get even more starved of capital. Don't you think that there's a possibility that that's just going to lead to so high an oil price eventually that ESG or no ESG, we will turn around and give those companies capital again? Thank you.
Indeed, that would be a possibility. Nevertheless, the oil price as such is more or less dictated by OPEC. And those guys, they have an interest to keep their market share. So if they continue basically pushing oil prices higher, they're going to they're going to cut the branch on which they sit. And that doesn't make sense. So they have to comply. And a too high oil price is basically a negative for them at the end of the day. And in particular, US shale is going to come back on stream as well. And that adds additional supply. And hence, we're going to weigh on the prices. There is a second element to which I may refer to. Just simply basically eliminating all the basically oil companies from our investment universe is putting a lot of pressure on these companies to move towards green. And there are two companies of which I know that we are successful in talking to them, one, and the other one simply rejects discussion with us. And in our talk, obviously in our investments, we also would invest in transition companies, right? Those who are open to transit towards something greener and those who aren't. And there we would distinguish, and that has substantial price effects. I know that there is a French company which has a new name today, with which we have an open dialogue, and there is another one which is, I have to be careful, overseas. I leave it open whether it's across the Channel or across the Atlantic Ocean, so no name here, with which we also try to have a dialogue, but we desperately fail. And we see the price difference, and we see the difference here. Thank you.
If I can just follow up really quickly. So you're saying that betting against ESG here might not be clever because basically that capital investment may just be carried out by someone like, in somewhere like Russia or Saudi Arabia or somewhere else. And okay, thank you.
Yeah.
Well, as we had, is it good? As we had Jeff Booth saying in the conference before, as about Bitcoin and new technologies, I also want to say that he defend that Bitcoin better than as an environmental friendly than an inflation system. And you as an asset manager, what do you think about the perspective of Bitcoin and as an ESG friendly? Thank you.
So just to be clear, do you mean that ESG is inflationary or?
No. Like as he said, ESG like Bitcoin is more in favor of ESG because it's more environmental friendly than a system that continues rising up and has to all the prices going up and it creates less abundance. So as an asset manager, what do you think about Bitcoin and about this narrative?
Indeed, ESG is, from our perspective, a much more important element to invest in going forward. And it's going to basically eliminate companies and push them on the sidelines. So in that respect, we would agree, yes.
Thank you very much. And let's thank all of the speakers of this panel.
Thank you very much
for your presentations.